Welcome to my channel. I am going to show you step by step how to value 3 auto parts stocks and look at their financial ratios. Comment if you have questions. I respond to every comment. Subscribe if you want to see me value more companies. Become a member of the channel and I could do a more in-depth valuation on the ticker of your choice. See the link in the description. The first company we're going to look at is Aptiv. And this company designs and manufactures electronic safety parts for cars. Let's get started with the model. They're a large cap company. Their market cap is $24 billion and they're trading at $83 a share. And to get the shares outstanding, that's market cap divided by stock price gives you shares outstanding, 288 million. We're going to need this number for later when we calculate the value of the company. So free cash flow is how you value a company. You estimate the future free cash flows and then discount that back to today's value. And free cash flow is cash flow from operations minus capital expenditures. And this company has positive and pretty consistent free cash flow each year, which is good. You want to invest in companies that have positive free cash flow because that means they're generating more cash than they're spending. And cash is king when running a business. Next is net income. That's a profit and loss on the income statement. And that equals revenue minus expenses. So it's the bottom line of the income statement. They also have positive and consistent net income each year. So the numbers look pretty good so far. Their revenue dropped a lot from 2016 to 2017, but did come back up to $14 billion. Let's look at the capital structure of the company. They have $4.4 billion of debt. They pay 3.76% interest on their debt. And the cost of debt is 3.32%. And that's the interest rate times 1 minus the effective tax rate. 53% of their capital structure is debt, which means 47% is equity. Cost of equity is a whopping 20%. And the way we figure that out is using the beta. The beta is how volatile the stock is relative to the market. And they have a really high beta, 2.28, so the stock moves more than 2 times the market, so it's a pretty volatile stock. And we use the capital asset pricing model to get the cost of equity. And their WACC is 11%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $11.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $10.5 billion. We divide that by 288 million shares, and we get a calculated stock price of $36. They're trading at $83, so they're trading at a 129% premium. It's a strong sell according to the model. Let's see what Simply Wall Street says. They're at $70, so they're also saying the stock is overvalued, just not as much as me. Let's see where the stock has been trading at the past few years. So it looks like it was pretty steady for a while, and then it took a pretty big dip at coronavirus, and it's come almost back up to where it was pre-coronavirus. Let's look at the financial ratios. They have a weak price to earnings. The median in the entire market is 15.8. The average is 23.5. Price to earnings is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 24.2. So investors are paying $24.20 for $1 of earnings. Price to sales is good. The median is 1.8 and the average is 5.2. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 1.7. So investors are paying $1.70 for $1 revenue. They don't have that good of a price to book. The median is 2.4. The average in the market is 5.4. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 6.3. So investors are paying $6.30 for $1 book value. Remember, equity is total assets minus total liabilities on the balance sheet. They have a good interest coverage ratio. The median is 3.9, the average is 12.7. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0, they're 8.7, so they can easily cover their interest payments. ROE is good. The median is 12%, the average is 8%. ROE is net income over equity. I like to see above 20%, they're at 26%. So they are providing a good value to the equity holders. Current ratio is also good. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2, they're at 1.3. The best way to look at ratios is to compare them to similar companies. I've done videos on BorgWarner, Goodyear, LKQ, Linamar, and Magna, all in the same industry as Aptiv. And if Aptiv has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are worse in price to earnings, price to sales, price to book, and current ratio, although they have a good current ratio. ROE, they're best of all the companies, which is an important ratio because earnings is how you make money. Debt, they're a little worse than average at 53%. The average is 40%. They're the largest company in terms of market cap at $24 billion, and they don't pay a dividend. The average in the industry is 0.84%. Only 2 of the 6 companies pay a dividend. You'll notice really big companies sometimes don't have good ratios, because it's like they don't really need to have good ratios. People still buy the stock because they're big and they're well known. So to summarize things, I have them trading at a pretty significant premium. They don't have good ratios, but they have good ROE and they're a big company. The second company is BorgWarner. This company manufactures transmissions and other parts for automobiles. Let's get started with the model. They're a mid-cap company. Their market cap is $8.1 billion. They're trading at $40 a share. And their financials look pretty good. They have positive and consistent free cash flow each year. Net income also looks good, although it's a little up and down. And their revenue looks pretty good. It's fairly consistent. It does drop a little from 2018 to 2019, but their margins are going up, so that's good. Margins is net income over revenue. It's how well you convert revenue into profit. They have $2 billion of debt. They pay 2.81% interest on their debt, and the cost of debt is 1.8%. 29% of their capital structure is debt, so 71% is equity. Cost of equity is 15.7%, and we use the beta to figure that out. That's how volatile the stock is. So it's a bit volatile. It's 1.74 the beta. The market beta is 1. Their WACC is 11.5%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4. That's $9.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.7 billion. We divide that by 205 million shares, and we get a calculated stock price of $42. They're trading at $40, so they're trading at a 7% discount, so it is a buy according to the model. Let's see what Simply Wall Street says. They're valuing the company at $44, so they're in a pretty similar range as me. Let's see where the stock has been trading at the past few years. It looks like the stock peaked in the mid-50s and now it's sitting around $40, so it could be a good value if you really feel this company is going to stay strong throughout the pandemic. Let's look at the financial ratios. PE is stock price over earnings per share. I like to see below 15, they're at 10.9, so that's a good ratio. Price to sales is stock price over sales per share. I like to see below 2.5, they're at 0.8, so that's really good. Price to book is stock price over book value per share. I like to see below 3.5, they're at 1.7. Interest coverage ratio is EBIT over interest expense. I like to see above 2, they're at 22, so they can easily cover their interest payments. ROE is net income over equity. I like to see above 20%, but 16% is not too bad. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.6. The best way to look at ratios is to compare them to similar companies. I've done videos on Aptiv, Goodyear, LKQ, Linamar, and Magna, all in the same industry as BorgWarner. And if BorgWarner has a number in red, they're worse than the average. They have a number in green, they're better than the average. They are worse than average in PE and price to sales. Even though they have good ratios, we always compare it against similar companies. They are better than the average in price to book. They're about average at current ratio. ROE, they're a little better than average. They're much better in debt at 29% compared to 40%. And they're a little lower than average in market cap at $8.1 billion. Their dividend yield is 1.72%, which is above average since there's only 2 companies that pay a dividend in the industry. To summarize, I have them trading at about intrinsic value. Their ratios look pretty good, and their financials seem pretty solid. The third company is Magna. This is a Canadian company. It is the largest automobile parts manufacturer in North America. We're going to look at the ticker that trades on the American exchange since they report their financials in US dollar. They have a market cap of $14.1 billion, so they're a large cap company. They're trading at $47 a share. And their free cash flow looks really good. It's between $1.5 billion and $2 billion a year. Net income also looks really good and consistent year to year. And their revenue looks fairly consistent. It drops a little from 2018 to 2019, but it's still pretty solid at $39 billion. They have $3.2 billion of debt. They pay 3.3% interest on their debt, and the cost of debt is 2.4%. They have only 23% of debt in their capital structure, which means they have 77% equity. Cost of equity is 14.5%. And we figure that out using the beta. That's how volatile the stock is. The beta is a little over 1.5, so that means the stock moves about 1.5 times the market. Their WACC is 11.8%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $19 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $18.4 billion. We divide that by 298 million shares. We get a calculated stock price of $62. They're trading at 47, so they're trading at a 23% discount. So it's definitely a buy according to the model. Simply Wall Street has them valued at $61, so they're also saying the stock is undervalued. Let's see where the stock has been trading at the past few years. So it looks like it's pretty steady, although it did dip at coronavirus like every other stock, but it's come up to almost where it was pre-coronavirus, so it seems like it could be a good value. Let's look at the financial ratios. PE is stock price over earnings per share. I like to see below 15. They have a solid 8.0. Price to sales is stock price over sales per share. I like to see below 2.5. They're at 0.4. Price to book is stock price over book value per share. I like to see below 3.5. They're at 1.3. Really good ratios so far. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0. They're at 22.8. ROE is net income over equity. I like to see above 20%. They're at 16%. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.3. The best way to look at ratios is to compare them to similar companies. I've done videos on Aptiv, BorgWarner, Goodyear, LKQ, and Linamar, all in the same industry as Magna. And if Magna has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in every single category except current ratio at 1.3, but that's still a good current ratio. They have the lowest debt of all the companies, and they pay the highest dividend, 3.3%, which is much higher than average because most companies don't even pay a dividend in this industry. So to summarize, I have them trading at a 23% discount. Their ratios are really solid. They have great financials. So this is by far the best of the 3 companies. Let me know what you think of the video. Leave a comment. I answer all comments. Subscribe if you want to see me value more companies. Become a member if you want to see me do a more in-depth analysis of one of your tickers. Thanks for watching.